Great. So welcoming on to the question solving stage of IAS23 borrowing cost. IAS23 borrowing cost. In our previous meeting or lecture video, we discussed about the various steps that we have. So in a quick summary, we define the accounting treatment of borrowing costs. So IAS23, that talks about the borrowing costs. So we discussed about one, what the borrowing cost. So the borrowing cost itself. Today we look at the second we look at the accounting treatment. So a quick summary. We said that there are two treatments. We have the benchmark or the traditional treatment. We also have what we call allowed or the alternative. Also look at one, the third one, to look at the commencement of the borrowing cost. So we look at the commencement, suspension, and cessation of what borrowing costs. So of borrowing costs. That is where we ended. Then finally we look at the types of borrowing. The types of borrowing that we have. Yes, we look at that one too. So that is where we'll pick it from. These are the theory section that we need to take care of. The three conditions for commencement, one condition for suspension, one condition for cessation, making what 5. We need to take care of that. If you have not gone through that video, then I have advice and go through it before finishing this. Fine. And let's see. So still moving on to a summary what we did last meeting. We also looked at the types of borrowing. And we said that there are two types. What? We have the specific and we have the general pool of funds. And that is exactly where we ended. So today we are just going to start with a specific borrowing and see how you can calculate the borrowing cost under this approach. That is all. Then right after that, we'll pick another section where we will talk about general pool of funds. Then at the end of the day, we also talk about mix, right? So mix, that is the next chapter. That is a mixture, right? For instance, you say you need 120. Out of the 120, specific borrowing was, let's say, 80. General pool of fund was 40. Good. So look at that scenario too. So that is the agenda or the game for the day. So let's start with a specific borrowing. Specific borrowing simply means you are acquiring a fresh debt or a loan to construct the qualifying assets. You are acquiring fresh loan or debt to construct the qualifying asset. That is what I mean by specific borrowing. So specific Borrowing. So you need 120,000 and you walk straight to the bank or any financial institution to pick a facility of 120. That is specific. Okay. In such situation, how do we determine the borrowing cost eligible for capitalization? So in that situation, so right here, BC eligible for capitalization. BC means borrowing cost, no shortcut in exams. Eligible. Eligible for capitalization. For capitalization. So that is that. Okay. Okay, so the borrowing cost eligible for capitalization will be equal to 1. The interest, let's put our currency here, probably working in dollars. So let's say so much less what you call investment income. Investment was income. Take it off, whatever you get, that is the borrowing cost eligible for capitalization. As soon as you add the loan value or the loan amount to it, you get the total value of the assets, total cost of the assets. And this should suffer depreciation. Depreciation must be based on this. So take note of that. Depreciation will be based on this figure. Good. Now, why do we subtract investment income? You know, you took 120,000 from the bank or $120,000 from the bank to construct an office complex. Probably you didn't spend all the 120,000 at the go. The money was spent in bit by bit. So if first time you draw 20, left with 100, we assume that this 100 will be invested because it's surplus. It's an idle for now. So invest it. So any investment income you earn on temporary investment of what? The surplus funds. We are assuming that use that interest income to offset some of what? The interest expense or the interest that you are paying. So that is the need or that is the essence of the investment income. That is it. So now let's pick a nice illustration to start the game. Let's pick a nice illustration to start the game. So I write some few questions in here, very short, and then you capture it and then use it to probably look at it. Okay, so this is what we will do. Let me dash the board. So I'll start by writing the question here, then we will solve it here, right? So let's start from here. This is Target PLC, yes. Don't be afraid. Good. Target PLC took an amount of $100,000 during 2019 to construct a qualifying asset or construct office complex or office building, which started from 28th of February 2019. Full stop. The loan was contracted or secured. The loan was secured on 1st of January 2019. 2019, with an interest of 12% per annum paid. Full stop. The expenditure expenditures were drawn as follows. Full stop. Okay, so what happened is this. I don't want to make things look tough. So on 28th of February, they said the following amount, the following funds were made available to the contractor. First, they give the contractor 40,000. Okay, so they give the contractor, let's say 20,000. On May 1st, 2019, they gave the contractor 25,000. On 30th of July. So, or let's say yes, on 30th of July, we give the contractor 15,000. So that'll be 45, 60. Okay, so let me. On 1st of October, they gave the contractor just 30,000. So this is 60, yes, 30,000. 30,000 was given to the contractor. Then lastly, on 31st of December, they gave the final money to the contractor based on the work satisfied. For 31st December, the final amount of 10,000 was given. Now note, I put a note in the question. Note 1. So note 1, let's put a note 1 here, even though I'll clean out the notes. So take note. Note 1. Targets, or the company can invest any surplus funds at a rate of 9% per annum. So Target PLC can invest what? Invest any surplus funds or idle funds. Surplus like what? Idle funds at a rate of 9% per annum, full stop. Not 2. The office complex was completed on 31st December 2019. 31st December 2019. 31st December 2019. 2019. But it was occupied on the 1st of April 2020 to mark the anniversary of the company. Yeah, it's true. Target PLC, our anniversary date. Anniversary date is around April, on 1st April 2020, to just mark anniversary, date. The useful life of the asset is 10 years. Assume useful life of the asset. Oh, sorry, we can't see. Sorry, let me continue from this angle. The useful life is estimated to be what? 10 years. We are done. The useful life is estimated to be 10 years. So can you make the calculation? It's estimated to be 10 years. That is all. It's estimated to be 10 years. Okay. So kindly take note of it, or you can just take a screenshot of it. Then that's this section and then solve it from there. Okay. Now let's do the requirement. Required. Calculate the borrowing cost eligible for capitalization. Calculate the borrowing cost eligible for what? Capitalization. That's the first requirement. That's A. Let's go to B. Calculate the current amount of the asset immediately after construction or immediately after completion. Then C. Calculate the current amount at the end of 2020. At the end of 2020, what is the current amount? Okay. So that's the question. Let's see how best we can look at it. So A says calculate the borrowing cost eligible for capitalization. B says calculate the current amount of the assets immediately after construction. After construction, what is the current amount? After construction, what is the current amount? Okay, so let's make some few questions here. The expenditure was drawn as follows, not as following. As follows. Okay. Then that is it. So C part is calculate the current amount at the end of what 2010. Okay, so that is it. Can I just the workings, the footnotes, so I can publish the solution there? When I give it to identify whether it is a specific borrowing. With a specific borrowing, they said that Target PLC took. So that means an amount of loan from a bank. We have to tell us a bank. We are paying interest at the rate of what? 12% per annum. That makes it specific what? Borrowing. So let's see how best we can look at this specific borrowing. Okay. So basically that is it. So I'm doing this section. So take note. First, let's apply the three conditions. Now, the loan, they took the loan when? 1st of January 2019. But the actual construction kick from where? 28th of what? February 2019. Okay. So all what will start by saying A. Borrowing costs eligible for capitalization like this. Get the examiner that with a specific borrowing, you should relax. Only two things you need. Number one, the interest. So calculate the interest. Please and please again, the interest calculate from the start. From the start of the construction towards the end of the construction. Take note. So have you seen here? One of the footnotes stated that the construction ended at when? 31st December 2019. But the construction started from where? 28th of what? February 2019. So that means the construction started from where? From February 28th up to 31st of December 2019. So indirectly, they start from March, 1st of what? March, indirectly. That's what it tells. Indirectly, 1st of what? March. So 1st of March up to 31st December. How many months? From 1st March up to 31st December. So probably January, February, 2 months are gone. So let's say 10 months, right? So from 1st March up to 31st December is what? 10 months. So this one from the start to the end, 10 months. Kindly take note. Please, some of the construction can take more than a year. If in a rare case scenario, some of the complex building takes more than a year, sometimes 5 years, 7 years on average. So take note. So if it is 7 years, I just calculate 7 years interest. Take note. If it is 10 years, calculate 10 years interest. But if the purpose of your examination, most often is within 1 year. Most often is within 1 year. So look at the starting point of the construction to the ending point. If we're not told the ending point, assume 31st December for that grade. So that is it. So let's start. So here, since the interest will be like this, they pick $100,000. So let me create column here, another column 2 here. $100,000. So So third examiner that this $100,000, the interest is 12%, so times 12% times what? 10 out of 12. How we get it? Why 10 out of 12? It will be 10 out of 12 because the construction lasted for 10 solid months. So interest too must be for 10 months. Don't forget that they pick the loan January, February, and then March, even though construction started for March. The bank will not like pardon them or waive off January and February interest. This interest must be expensed in the P&L. Interest at this period should be what? Expensed in the P&L. Why? Because at that day they've not started the construction. So when we don't need to capitalize. Don't forget that we went through three rules for commencement. 3. 1. First, expenditure on the qualifying asset has been incurred. Yes, they paid for it on 28. 2, borrowing costs has been incurred. In fact, they started even incurring borrowing costs here. Fine. Number 3, activities necessary to complete the assets for its intended use or sale is in progress. Yes, they started it. They started on what? March. So that's why you're starting from March. So kindly, what do you get? Kindly give me the answer. So you get 10,000, right? Should be the total interest. Agree. That should be the total interest on this value. So take note of that. Total interest. Okay, then third examiner that let what? Any investment income from ideal funds that were invested. Okay, so let's start. Let's start. Now, before you start that one, pick your question paper. If going by paper base, pick the question paper. If you're going by computer base, then what you have to do is you have to be working it alongside. Now, they pick $100,000 and on 1st January 2019. So this $100,000 was a bit free until when? The first amount paid. So the first amount was paid when? 28th of what? February. Now it tells me that this money was free until 28th of February. And then as a business or a rational company like Target PLC, we will not keep $100,000 in our account for 2 months for free. No, we must invest it. And then we can invest it at the amount of what? Where the rate is 9%. So therefore, for 2 months, because for January and what? February, 2 months. So third examiner that January investment, third examiner, January investment. We are going to invest, let's use it, January investment, which will be invested in when? 1st of January, right? So they will invest the entire 100,000 like this at the rate of what? 9%. For how many months? 2 out of 12. Yes, for 2 months. Whatever answer we get, we put it in. How we get that? Now, after the first one, let's do something. Let's say you have to do it first. Target PLC took 100,000 to construct a qualifying asset because an office complex. Good. Now, this 100,000 was free or idle until the first amount taken, which was on 28th of February. So now tell me the balance. So create a column here, be including the balance. So after the first withdrawal, the total amount secured was 100,000, and then they paid 20,000. So they pay 20,000. What will be the balance left after the first withdrawal? So the balance left after the first withdrawal will be 80,000, right? And this 80,000 was free until the next withdrawal, which took place on 1st of May. So kindly tell me, from 28th of February up to 1st of May, how many months? Great. And please do not feel shy to count your fingers. After you pass the exams, probably they will not tag it on your forehead that, oh, you counted the fingers. No, please. Exam soon. Just raise it, start 1, 2, 1, 2, 3, 4. In that order, count it and put it there. So from 28th of February up to 1st of May, how many months? Great. So February will not be part, right? So start from March. So March 1, April 2, May 3. So 3 months. So write against it 3 months. If you do this when you are solving the question, you won't find anything difficult. So write against it 3 months. So write 3 months against it. Now let's go to on first day you took 25 out of the 80. What's the balance left? So 80 minus 25, the balance will be somewhere okay, for these 2 months, not 3 or for these 2 months, because the May is first, so the May is not at the end of have you seen how tricky sometimes will be? So let's say 2 months. Good. So it should be 2 months. Okay, let's count it again. Let's count the month again. February is gone. So March, April, May is not part. May will not be part. So April and then March. So 2 months. 55,000, right? This one will be invested for how many months? So starting from counting from 1st May up to 30th July. 1st May to 30th July, how many months? 3 months then. Let's see. So that one May will be part, right? Yes, May, June, and then July. So making 3. Good. So that will take 3 months. Then this money is free until 30th of July, where they invested 15,000. So here left with what? 40,000. And this 40,000 will be free until 1st of what? October. So from 30th July to 1st October, how many months? From 30th July up to 1st October, how many months? 2 months. Okay. So July will not be back. So September, 2 months then. Okay, so August, September, right? October is not passed, so 2 months. I'll take that. So this money is free for 2 months. So just be noting it down. Then finally, 30,000 was withdrawn from the account. So that was 10,000, right? And this 10,000 is free from 1st October to 31st December. So how many months? From 1st October to 31st December. How many months? 3 months then. So October itself, November and what? December. So 3 months. I like that. When you do this, you are safe. So now you come here and come and then do the calculation. Kindly help me with the calculation of the first one. If you get the answer, kindly send them to me. Let me also do my calculation here. So 0.79 times 100,000, that should give us something like 9,000 divided by this one versus, so divided by 6, right? So that's 1,005, agreed. So the first one is 1,005, then put it down. You get $1,005. Then the next investment took place when? 28th of what? February. Right here, 28th of what? February. So 28th of February's investments. So let me do it well. 28th of February. But they are going to invest what? 80,000 for 2 months. Times 9% times 2 out of 12. So what will be the answer? So you'll get that 9 times 80, 1, 2, 3. That'll be 7,200 divided by 6. That should give us 1,200. I like this question, though. 1,200. So let's move on to the next one. The next investment is 55,000 going for 3 months. So if you do this way, you don't need to worry. Which will be invested when? Its equivalent date. So 1st May. Right here, 1st May. 1st May investment. Tell the examiner. They are going to invest 55,000 times 9% times 3 out of 12. And now to get something like, that'll be .09 times 55123. That's 4950. Divided by 4. So that's 1238. I've run it to the nearest dollar. So 1238 to the nearest what? Dollar. Okay, so the next one is they are going to invest 40,000. So that one, when are they going to invest it? They will invest the money on 30th July. So 30th July, they will invest an amount of 40,000. So times 9% times the interest, right? So kindly help me with that calculation. So that should be, let me clean this side small. So 30th of July, they will invest 40,000, 9% times 2 out of 12. 2 out of 12. Okay. Okay, that is great. Okay. So what should be the answer if you have it? Is that 675? Oh, I'm getting 600 though. Someone's getting 600. So 40,000 times 9%. So 40, 1, 2, 3 times 0.09. Let's give out 3,600 divided by 6. That should be 600. Yeah. Great. Yes. Okay. Okay, you said 1 out of 10. The answer is 600, right? Okay. I now get your point. So yeah, 600 cities. Then we move on to the last one. That is where they will invest the 10,000. So 10,000 will be invested on 1st of October. So 10,000 cities we invested there times 9% times how many months? We said 3, right? So 3 out of 12. And you had, okay. Okay. It's 225, right? Okay, so 10,000 times 9% should give us somewhere 900. Then 900 divided by 4. 900 divided by 4 should give us 225. Great. So 225. So kindly put all the investment income together. Let us use the investment income to offset some part of what? Some part of the interest that we are paying. The remainder is the borrowing cost that we can do what? Capitalized. So that is gain. Okay, so 4,763. So 4,763 should be the investment income. So put it here, 4,763. Kindly put it in brackets. And finally take it off from the total interest of $10,000. Then I know that we will find the borrowing cost eligible for capitalization. To take it from 10,000, what do you get? 5,237. 5,237. 5,237. So that's the borrowing cost eligible for capitalization. So right here, BG, eligible for capitalization. Eligible for capitalization. We are done. We need to just add. The B says find the current amount immediately after construction. Just add the loan amount to it. That is all. Oh, sorry, this section is not coming. Okay, so I think it's a bit okay now. So just add the loan amount to this, and then to give you the amount eligible for what? Sorry, the total cost of it. So let me do that one here. I might clean this one. Just this section. Let me clean it. Now, just for like continuation from here, I'm continuing from this angle. So the B part, the current amount of the assets. First, we bring the borrowing cost eligible for capitalization in dollars. We had what? $5,237. Then bring the loan amount, which was $100,000. So therefore, the total cost of the asset, which is the same as the current amount, total cost of the asset right after construction becomes 105,237. That is that. So that is what we can look out for. Okay, so that is what we will look out for. I'll take this section off. But this data, I need the data again, so I'm not clean the data. This very data, I need a data, so I'm not clean it. Okay, so basically that is that. Depreciation is based on this amount. However, tell the examiner that interest for January and February must be expense in a P&L as well, finance cost. So take note. Because we charge only 10 months interest. So the 2 months interest must be expense in a P&L. That is what we have to look out for. Okay, so basically, that is that. Now let's go to the C. C said that we should look out for the depreciation for 2000 and what? Current amount. This time around 2020. At the end of 2020. How do you find current amount? The cost minus what? Accumulated depreciation. Let me take this section off and do the depreciation here. Cost is nothing by cost minus the accumulated depreciation. Can I claim it's going low? Can take a screenshot if I'm not, or the jot some point down. Going low. Okay, gone. Okay, I need my data back, so I'll come for it. Okay, so depreciation. Let's look at depreciation here. So depreciation for the year will be, what's the cost of the asset? The cost of the asset is 105,237. What is the useful life? 10 years. Now they said something in the question. Even though the asset was completed in December 2019, the asset was brought to use on 1st of April. Why? To mark the anniversary of the company. Yes, it's true. In reality, Target PLC, our anniversary marked from April. So when we constructed the building, office complex 2019 December, we waited so that to mark the anniversary, to celebrate it well, to enter into a new building, a new office complex, new office set, 1st April 2020. So the question is, should the depreciation start as soon as we are done constructing the asset, or the depreciation should start when we started using the assets? Which is which? Good. So that is the question that we are asking. We are saying that the depreciation should be charged as soon as the asset is what? Available or ready for use. When it was what? Ready or available or completed. Not when we started using it. Let me ask a question. Let us assume that this building will last for 10 years and we started using it here. Does it mean that the 10 years will start when we started using it? No, not at all. Once it's ready, start counting. So if you probably, when everybody is young, we have a lot of quite huge lifespan. As soon as we are giving birth, your time starts counting when you enter the head too. Not when probably you know how to talk, or not when you really understand certain things. No. The same thing, we're also saying that not when you start using the assets. No. Because you've seen a very brand new vehicle at the shop, spending over 6 months at the shop, whilst a very old vehicle is always on the road moving. So it doesn't matter. So start depreciating it, right? So that note, depreciation for 2020 will be a full year, which will start from January. Full year. So that is that point. Okay, so to the nearest whole number, the depreciation will be 1524. So 10,524 to the nearest whole number. So therefore, current amount to be just take it from the cost of the assets. You take it off from the cost of the assets. So current amount is equal to that examiner cost of the assets happen to be 105,273. Accumulated depreciation is 105,24. What happens is the current amount becomes what? Something like, so that's 13. Okay, so 13 gone. That's 90 something, right? So 90,013. If my calculator will be correct. I can confirm that that's 105,237 less 90,13. Right. Kindly confirm that for me. My calculator is giving me different answer. Okay, so this will be 94,713. We are done. So that's the current amount. So we are done with this particular question. Now, let me chip in this same question. Please, you are solving the same question. You have only 3 minutes. The note is this. Have you seen? I gave some note and let's add this one to it. Let me add this note to it. Now, assuming that in a month of June, let's assume that in a month of June, the employees were on strike, which temporarily halted their construction. So the whole month we did not work. So the month of June, we suspended the construction because of strike action or shortage of raw material. How will it affect the calculation? Tell the examiner that the amount, because this activity is as a result of unplanned, it must be suspended. Borrowing cost must be suspended for the month of June. So that means in calculating the total, that means in the calculation of the total interest, where we had a 10 months, it will be reduced to what, 9 months. Why? Because further June is not passed, so 9 months interest. That is the implication. That is the implication. That is the implication. Okay, so take note of that. All other calculations remain the same. Okay. Let's see the next section. Now the next section is general pool of fund. General pool of fund. So we're going to now solve a question on general pool of fund. General pool of fund simple means you finance these qualifying assets, the construction of the qualifying assets, with your existing borrowings or existing funds as a result of what? Over borrowing from last or the previous years. The previous years. Okay. So let's see that one. How do you go by that? Okay, so that is where we are now. So we have what we call number 2 is the general pool of what fund. You put some old funds that are idle, surplus one now. So that one, the very first step or first thing that you have to do is calculate what you call the capitalization rate. Capitalization rate, in which we normally call it weighted average cost of capital. Probably I feel okay by calling it weighted average cost of what debt. I'll explain why I like weighted average cost of what debt. Okay, that is it. Okay, so that is first you have to calculate capitalization rate, and that is the borrowing cost. So that is the WACC. That is what we are going to use to calculate the interest. That is all. So now let's go through and see how best we can determine that. Okay, so let's pick a question. At least a question will give us a picture before we zoom into highly exam questions. So I'll start like this. So, but the question, this information is part of the question. Yes. So this information is part of the question. So questions start like this. So again, travel code. Travel code. Started construction of a piece of machinery, of piece of equipment, on 1st January 2019. So take note of this. This one, the construction started from where? 1st January 2019. So 1st January 2019. That is where the construction started from. Yeah, I wanted to wet the case. Okay, he has not wet the case. Let me go by normal. Before I started wetting it. But this is our first illustration on general flow fund. I shouldn't wet it. So construction started from this and completed on 31st December 2019. Full stop. So full stop. The entire construction was financed through an existing borrowings as follows. full stop. So this is the finance section. So first, even though the construction of the piece of the equipment took place exactly 1st January, but they started incurring cost on what? 28th of February. How many? $20,000. We are done. Okay. Let's go to the footnote. So note 1, extract from the financial position of Trafuco is as follows. So note 1, extract from where? Financial position, extract from the financial position. Why are they giving us the extract from the financial position? Yes, we're informed that it was financed entirely from what? Through an existing borrowing. So if it's an existing borrowing, what do we do? Then they have to give us the list of all their existing debts, so that we can now strike average the interest rate that we should use. Okay. So let's say 8.5% debenture with a value of, let's say it's in dollars, $180,000. Then 12% loan note, which is $200. $200. Then 7% loan stock. Then they've put in something here into brackets. It was secured to construct a qualifying asset. This is $150. It was secured to construct a piece or a qualifying asset. Or let me pass a note so that it will not disturb us. Okay. This is note 1. Let's go to note 2. Note 2. So note 2 will explain this loan note. It says 7% loan note or loan stock or secured to construct a qualifying asset. That is into brackets piece of machine. You construct a machine. That is it. That is all. Useful life of this equipment is for 10 years. That's note 3. Useful life is for 10 years. So take note. It has the same note as the previous one. Requirement, the same thing. The requirement is the same as the previous one. So required. A, calculate the borrowing cost eligible for capitalization. Calculate the borrowing cost eligible for capitalization. Then B, calculate the current amount right after capitalization. Then C, current amount after 1 year. That is all. Current amount after 1 year. So current amount after 1 year will be great. So now kindly just some few points down. Let's provide solution to it. But all these questions that has been articulated in your material, they are more in there, so You know why I'm solving this one? Because this one don't have solution. But most of the items or questions the material do have solution, so you will be fine. So now let's provide solution to this. So first, as you can here. Oh, hi, Bajambo. Sorry, I can't remember the figure, so let me write them here. This one, there was a figure here, 200,000, right? And this one is 150,000. Sorry, this question was just manufactured. So if I can't try now, I might not be able to remember. Okay, this one is the venture. This one is loan notes. Okay. This one is convertible loan. Let me clean it and start from here. This one I'll start from here. So this question is general pool of fund. In general pool of fund, they will not tell you the capitalization rate. You have to calculate. That's the first thing you have to do. First, calculate the capitalization rate in general pool of fund before you start everything. How do you calculate the capitalization rate? Here, because you have a lot of existing funds, you pick the funds from any of them, so you have to find the weighted average cost of local capital. I also call it what? Debt. I'll explain why. Now, this is the issue. Now, sum up all the expenditure. You get 100,000, right? Please do not argue that, oh, if it is 100,000, then I can decide to, or this one is 200,000. Oh. I can probably decide to pick the entire 100,000 from where? From 180,000. So therefore, my interest should be, I pick for 180,000. So therefore, my interest should be 8.5% straight up. No, please don't assume that. Why? Because these funds and these funds, you pick maybe 50 here, 50 here, making 100,000. So that is why we have to weigh the average. You pick from both sources. Don't pick from just one angle. Great. So that's the rule number one. Don't say that, oh, because what I need is 100 and the first debt is more than 100. No. Rule number two, we only need free loans, free idle funds, funds that are idle. Last week you picked a certain money, that money is still with you. Use that money, that is free. But if last week you picked someone's money and that money had a purpose, then do not touch it. That is it. So out of these three loans that we have here, which of these loans do not have a purpose? So add all those ones. This one does not have a purpose, does not have a purpose. So they are idle. But this 7% loan stock have a purpose. We were told that the loan stock was secured to construct a qualifying asset, another qualifying asset. So that means this loan is busy. It's busy. They are busy using this loan to construct a qualifying asset. So we should not include that. How we get it? Okay. So when you are going to take the extract from the balance sheet or the company's debt, consider the debts that are free, not debts that are probably secure to construct another qualifying asset. So it means that in calculation of the weighted average, I will not include 7% loan stock. I will not include 7% loan stock. Why? Because according to note 2, it was stated clearly that it was secured for another qualifying asset. So I cannot use it for this purpose. That is all. So this is what we have to do. Basically, this is what we have to do. Basically, this is what we have to do. So third examiner that first calculation of what? Capitalization rate. Now we have to weight these two debts, their average. So that's why I normally call it weighted average cost of debt. Although they normally pronounce or call it at weighted average cost of what? Capital. So capital comes in when there's equity components, unless that company is what? Unjed. But let's see. So first of all, write the interest here and write the debt also here. So let's start. The first one is 8%. What's the name? Debenture. Can you calculate the interest for me? Open a bracket. Third examiner that it will be 8.5% times what? The value of the debt. The debt value is what? 180. So times 180. Please, what's the answer? If you calculate the interest, put it in. So 0.85 times 180,000 for that particular year. That's 15,300. Agreed. 15,300. Agreed. What is the value of the debt in dollars? The value is $180,000. That's the value of the debt. Let's go to the second debt. The second debt is 12% loan note. So 12% loan note. Now to do your calculation, what is the interest? So it will be 12% times. That will be 12% times 12% times 200,000. Okay. So that should give us 24,000, right? The debt itself is what? 400,000. Good. That's all. Now sum all together. If they have a lot of loans, kindly do this for all of the loans. But please make sure that you are touching or you are selecting loans that are free, that are idle. Don't touch any loans that have a purpose. Good. What's the total? So put them together. So 24 plus 15 should give us somewhere 39,300. This should give us 380,000. Okay, so 380,000. Once we have this, we can take off this one from the question. Now you get it, right? Okay, so what happened is this. The weighted or the capitalization rate. The third examiner that capitalization rate will be is equal to total interest all over the total debt times 100. Sorry, you can't see. What's the total interest? 39,300. What is the total debt? 380,000. So what's the percentage? So the answer should be around 10 point something. This is what you get times 100. The answer should give us 10 point something. Okay. 10.34%. Perfect. I like the answer. Can we run it to the nearest whole number 10%? So the nearest whole number 10%, or you can also use the 10.34% to mark it for you. Okay, now let's come here. Now, that's the first thing we have to do right after calculating the capitalization rate. Right after calculating the capitalization rate, you move on. Just a second. Okay, so now right after the capitalization rate, we have to go ahead and now provide with calculation the interest or the borrowing cost eligible for capitalization. So let's do that one here. Which side should I claim? Which side should I claim? Can I claim this side? Yes, this side is going to go in. Okay, so quickly let me take it off so that we can start the calculation. So this capitalization rate. Now we are now going to calculate the borrowing cost eligible for what? Capitalization. Now take note, construction started from 1st January, but the first payment was made in when? 28th of February. They made $20,000. So even though construction started from January, we will start from where? 28th of what? January. So take note of that. Okay, so that's that. Oh, sorry. Oh. So I have them here. Now let's see. What's the first payment? So that one, we only have one currency. So let's calculate the interest. So interest, please, with this, if you take the amount spent or the expenditure multiplied by the capitalization rate, that is all. Please, with this, there was no, there's no issue like investment income. No, yeah, there's no investment income. Tell the examiner that if the funds were idle, you did not invest these funds, but now that you've seen the purpose for it, now that you are going to invest it, no. The issue is that these funds were monies that you probably secured previously. Now some of them are still available. So it's not the time, or this is not the time we are going to invest. So no investment income, simple. Now the first one was 28th of February. So on 28th of February, what will be the borrowing cost? The 20,000 times the capitalization rate of 10%, or you can also make it 10.4 times how many months? So from 28th of February to the end of the construction. So how many months? Friends online. From 28th of February up to the end of the construction, how many months? How many months? $10 solid months. So times 10 out of, let's shift the dollar here small. Times 10 out of what? 12. So probably what would be the answer? So therefore, get something like 2,000 times the, then back again, bye-bye. 12 again. So that's 16667, right? Okay. So 166. Next one number 7. Agreed. 1667. So 1667. Then we look at the next one is 1st May. So 1st May, they took 25,000 cities, also times 10%. How many months? From 1st May to the end of the year. How many months? Don't first have to count your fingers. Now let's count together. first May is part time. Yeah, so May. From May to December, and then it's 8 months, right? So 4 months is gone. May is the 5th month. So if 4 months is gone, the whole year we have for 12 months, and 4 is gone. So left how much? 8. So 8 out of 12. So that means 2,500. This one, 2, and then 3 times 2 divided by 3. That's another 1,667, right? Wow. What a coincidence. What a wow. 2,667. Wow. Now let's see. Let's go to July. So on 30th of July, they also took something like 15,000 times 10%, right? And that is 5 months, 30th of July. So that one counts from July is gone. So let it 5 months. Yes, I agree. 5 months, I agree. And now to give us, so 1,500 by 5. So 1,500 times 5 all divided by 12. That's 625. I get that. So 625, that's perfect one. Then on 1st of October, they pick another words, 30,000. So they took 30,000 again, times 10%. How many months? So times 3. I like that. Because October to December is how many months? 3 months. Good. And this will give us, that's 10% of 3,000. That should give us 3,000 divided by 4. 750. I'll take that. 750. Then the last one, everybody try to take a picture of it and then page. Okay, so this is how the last one will be. The last one, third examiner, it was probably picked from 35 December 2019. I picked 10,000, so open a bracket, times 10%. Now over here, you say times 0 or times 0 out of 12. The answer is 0 before sum all of them up, or just times 0. Yes. If you don't do all, it will not change your answer. But if it's a paper base, you lose 6 for this, right? Okay. So take note of that. And please, become and putting that inside the marriage. Okay. And then the nil. Okay, so that's the end of the game. Can you sum all up? 4,709. Can't you get anything to run and get it? So 4,709. Perfect. So therefore, what will be the total cost of this equipment? Total cost of equipment. So this becomes the beast, no shortcuts. Borrowing cost eligible for capitalization. Add the cost here to be construction cost, not loan amount. Or add the cost of construction. That would be 100,000, right? Putting everything together, I get 1,04709 to be the total cost of the total cost involved. Okay. So basically, that is what we are looking for, basically. Okay, so that's the end of the game. What left is question solving. Question solving with a massage. Let me give my trial question in advance. So let me give the trial question in advance. Trial question in advance. Okay. All the questions are yes. The question like this, we have to look at this. I'm going to pick it from the tutorial questions. So tutorial question 1 probably is your trial question. According to IAS23 borrowing cost, clearly explain borrowing cost 2 marks, outline the benchmark and allow. What's the benchmark? Treatment, benchmark treatment, that's the traditional view. Benchmark, all borrowing costs must be expensed, that is all. And what is allowed, or the alternative treatment of borrowing costs. That is one of the following IAS23, some of the borrowing costs eligible for capitalization need to be capitalized, or all borrowing costs eligible for capitalization should be capitalized. That is all. Determine the current amount of the canteen in the books of new fashion, the method after the Fed 2008. So this one will be your own. You are trying it for me nicely. And I need the answer within 24 hours. Now, there are about 11 questions fully solved in here. So those one I will not touch any of them, but they do have answer in, especially question 10 is a bit technical. The answer is in there. I'm just saying that the answers are not there. There's a particular question here that question 2 to try it. Good. So I'll do question 4. I'll do question 4, and then as usual, if I do one, you do one. Then you do question 5. So can you write the questions that you are doing now? You are doing question 1. You are doing question 5, and then you jump. Don't do any question again. Don't try any question again. Go to the last one. The last question. The last question. Question 10 is part 2. So I do question 1, question 5, question 10, and then the last question number 12. Question 12. Question 12, I tried them for me. So able to get it. $200 should be for you. $200. I can start. When I would do it, after I submit the answer, you will scan through with our system, and it detects maybe even a tick wrong. You have to pay $150. Yes, you have to pay the $150. Take note of that. Okay. Okay, so let me go to question 4. I'm doing question 4, and then you are doing question 5. Yes, we are doing question 5. So question 4, that one is a combination, is a mixture of specific and general pool of fund. So look at how we're going to solve that question, the mixture. Mixture of what? So let's look at that one quickly. ABC Limited commenced the construction of new office block on 3rd January 2010. They commenced when 3rd January 2010. The following payments were made during 2010. Okay, all of them were there. All of them, in fact, they're there. You can see them here. Let's move on. The first payment on 31st January was funded from the entity's pool of debt. Pool of what? Debt. However, the enterprise succeeded in raising a medium loan for an amount of 800,000. So that means this 200,000 was for general pool of fund. Then at 31st March 2010. Okay. So that means the one on 31st March, they use what? The specific borrowings of what? 800,000. Okay. And then June 2, then let's see something here. As of 31st March 2010, with a simple interest of what? 9% per annum, calculated and payable monthly in arrears. So that means the interest rate is simple, like 9% on each figure. These funds were specifically used for this construction, not any other construction. That was called specific borrowing. Excess funds were temporarily invested at 6% per annum monthly in arrears payable in cash. Again, they put again, and then start more. Again, the put of debt, but again is zero. I like putting that first. Again, the pool of debt was used to an amount of 200,000 for the payment on 30th November, which could not be funded from where the medium term loan. So this is something here. Now, kindly be with me. They took this 800,000. Okay, let me start all over. The first payment was made out of general pool of fund. Fine. Second payment was made out of the specific loan that they took from the bank, which is 800,000, and they spent 450. So there was a surplus of what? Probably 350, right? Perfect. Then what happened next is they spent another 100, making 550. Okay, there's a surplus of 250. Fine. October they spent 200. Okay, so left with what? 50. And that 50,000, they added a pool of fund of 200 to it, and they spend that money on what? 30th November. Take note. 30th November. And they spend that money on 30th November. Good. Okay. Now that is the meaning. Now their construction project was temporarily halted for 3 weeks in May due to substantial technical administrative work carried out. The management of ABC Limited adopted the accounting policy of capitalizing borrowing costs. Once they are using IAS23, this assumption probably is just a repetition. Okay. Now this one, do you suspend or you carry on? Let me hear from you. Construction of the project was temporarily halted for 3 weeks in May due to a substantial technical administrative work carried out. So you continue capitalizing or you suspend? Let me hear from you. So we have to capitalize because it was what planned, that is all. Continue because technical administrative work is part of the plan game. But if you do let's say strike action, shortage of raw material, something that you did not plan for, catastrophic risks, accidents. You don't know what happened. The entire building collapsed. Pillars were strong, but it still collapsed. So you have to now raise the pillars again. Good. Okay, so let's go straight to the point. First, because it's general pool of fund, you can decide to probably look at the general pool of fund first or the specific one first. Let's go and calculate the capitalization rate, and then we move on. The capitalization rate. Okay, so capitalization rate. The following amount of debt were outstanding at the statement of financial position date of the company. Bank overdraft, medium term loan, 800,000. Okay, so there's a suggestion here. Okay, right. So let's continue. We'll finish soon. Okay, right after this particular question. Okay, so the following amount of debt were outstanding at Fed at the statement of financial position date 31st December 2010. Medium term loan 800,000. Bank overdraft 750,000. 10% 7-year loan note dated 1st October 2009 with a simple interest payable annually at that's 9,000. But total overdraft interest charged by the bank amounts to 38,800. 33,800. That is it. There's a question here. Okay. Great. So that is that. Now we have to calculate the capitalization rate first quickly. So we'll calculate that one first. Then we move on with that. We move on with that. We move on with that. Okay, so let's see how best we can start the game. And I start no stopping. So let's go to the board and let's start the game. First, let's go ahead and calculate the capitalization rate so that we can start with that general pool of fund. Over here, you can quickly start with the specific here. So you can start with a specific. Okay. So calculate of the capitalization rate. So first, let's do the workings at the side. Further workings here. So capitalization rate, cap rate. That examiner. First, write interest here. Write the debt itself here. Agreed. Interest versus what? Debt. Don't forget your currency. You're reporting in dollars. Even though there's a city there, just report in dollars. Not for cities, but let's just obey the question. Right? Let's go back to our cities. So the first loan or the debt will be the first debt happens to be medium term loan, 800,000, no interest. So I'll not pick that. 10% bank overdraft. There's an interest here. Overdraft interest happen to be 33,000 overdraft. Let's go. And then the principal amount is what? 750, so 33,800 and 750. 33,800 and 750. I'm writing before I forgot to, yes, 750 tab. It's called overdraft, right? So bank overdraft, that's the figure. Let's go in and go and pick the next debt. The next debt is 10% 7-year loan note, and the value is 9 million. And it's 10%, right? So 9 million. So I guess something like 7-year loan note. Calculate your interest, 10%. So 10% times the 9 million. That should give us 900,000. The principal debt is what? The principal debt is 9 million. Sum them up. You get 9,338,123. Put them together, 9,750,000. So what's the capitalization rate? So therefore, cap rate will be all over 9,750,123 times 100. Any answer for us? So that's the capitalization rate. Can you finish us with the answer? Can you finish us with the answer? Okay, so 933,800 divided by 9,750,123. So that will be 9 points. What I agree times 100. That's 9.58%. 9.58%. 9.58%. So that's 9.5%, 9.6%. The nearest whole number, 10%, or not agree. So here, let me make it 9.58% or 9.6%. Let's go. So calculation of borrowing costs eligible for what? Capitalization. Here I'll start from the specific borrowing first and enter into general flow of fund. So right here, solution, borrowing costs eligible for capitalization. Eligible for capitalization. I'll start with the specific borrowing first. So what's the specific borrowing? Let's start with that one first. So specific borrowing. That one we need two currencies. What is the interest? The interest. The amount was, the loan was secured. Let's go to the question and when the loan was secured. When the loan was secured, the loan was secured on 31st March 2010. That is where they raised the medium-term loan. Okay, so the reason why we did not add the medium-term loan, we not added it because this medium-term loan was the one that we raised. So this one is there for a qualifying asset. You don't need to touch it in calculation of the odds, the weighted average cost of capital or the capitalization rate. Okay, so 31st March 2010. So calculate from 31st March up to the end of the year. Have you seen this question? It was totally silent about the completion of the asset when the asset was completed. If they was silent, just use 31st December. Check the beginning. Just use and check their financial position date and use 31st December. So that means this loan will run from where? From 31st March up to when? December. So how many months? And then interest is at the rate of 9%. Okay. So from 31st March up to 31st December, how many months? 9 months. Okay. 9 months, got 3 months is gone. Okay. And the big 800,000 interest is 9%. I take that. So therefore, the interest will be that is 800,000 times 9% times 9 out of 12. That is all. What do you get for the interest? So 9. So 800 times 0.09. This will be divided by 4, right? Okay. So divide by 4 times 3. So that's 5,004 or 54,000. The total interest 54,000. That is on less what investment income from temporary investment income from investment income. So basically, now let's see this one. Let's do it here. They pick 400,000 on 31st March and they spend 450 immediately. So let me that much 350, and that 350 was free until 30th June. So from 31st March up to 30th June, please, how many months? So that 350 will be free for that period. From 31st March up to 30th June, how many months? 3 months, let's count to 31st March. So let's say 31st March, April, May, and what? About June. So I'll take that. So 3 months. So, and they will invest that money when? 31st March, right? 31st March investment. Open a bracket. That examiner that it will be nothing by. I wish I can squeeze that calculation somewhere there to be. Let me see if I can do it somewhere there. It will be something like into brackets. 31st March. Open a bracket. 350,000 times 6% times 3 out of what? 12. Let me see this one somewhere here. Now it will be 3 out of what? 12. So take note of that. Now why 6%? Because they can invest at what? 6%. Why is it? 6%. They can invest at 6%. So we should take note of that. Now let's move on with the game. So kindly furnish me with the answer. So 350,000, 123 times 0.06 divided by 4. So divide by 4. That's 5250. So let's write it here. 5250. Again, let's go and see. Again, the fund, so on 30th June, they took 100 out of the 350 remaining. So let me go 250. So that 250 will be free until 31st October. So how many months? 30th June to 31st October. So that would be July, August, September, and what? October. So that will be around 4 months. Perfect. So 4 months, which will be invested in when 30th June. So that exam now that they will invest 250, sorry, times 6% times 4 out of 12. And that will give us something like, so 250,000. Sorry, the thousand not come over. It should be 250,000 times 6%. So 250 times 6%, that would be 5,000. Okay. Then let's go to the last one. 250. Then on 31st October, they took 200. So that was 50. And that 50 was free until 30th November. So from 31st October to 30th November, how many months? So October is not bad. October, November, so just 1 month, right? 50 be free for just 1 month. So take notes. 11,250, they took 200. So 11 was 50, and that will be free until 30th of November. So therefore, we'll have it will be invested in 1st October. Examiner that 50,000 will be invested at the rate of 6% for just 1 month. Just 1 month. So that will be 50. 1, 2, 3 divided by 12 times 0.06. That will be 250, right? Put all of them together and let's see. So therefore, this one give us 7,000 or so. So 10,500, right? So the total investment income should be around 10,500. Take it off from the investment income to get something like 44, so 43,500 to be the net coming from where specific. This is specific borrowing. Again, third examiner, we are the general pool of fund. Let's hit the general pool of fund. Sorry, I have to step this guy down. Let me step him down. So come down and write general pool of fund. General pool of fund. Underline it. So let's go specifically to places where they use the general pool of fund. The general pool of fund was used when 31st January 2010. So from 31st January up to the year end will be 31st January up to the year end will be 31st January up to the year end will be 11 months, right? So 200, and then we have to use the capitalization rate that we calculated. So don't forget. Right here 31st, sorry. Right here 31st. Let me read 31st of January. Third examiner, open a bracket. That the big 200,000 times the capitalization rate, the one that we calculated. What's the capitalization rate? We had 9 point, let's use 9.58 and 9.58% times 11 out of 12. What do you get? So the capitalization rate, so that would be 2,000,000 divided by 12 times 11 times 0.0958. Okay, plenty point to 17,563. So 17,563. And again, general pool of fund was used to the tune of the last one here. On 30th November, they spent 250. 50 is coming from the specific. 200 is what general pool of fund. And so from 30th November up to 31st December, how many months? Probably one, only January. Sorry, only December. So again, we come here 30th November. So that one too, it will be 200,000 multiplying the 9.58% times 1 out of 12. And that one to give us something like 200,000, 1, 2, 3 divided by 12 times 0.058. Fact 1596, right? So 1,596. Put all of this together and get a total forward for that of the general pool of fund. Okay, so what do you get? What do you get? So 19,159. So 19,159. Then you put all of them together, total, and then that gives us the overall borrowing cost eligible for capitalization. And that's 62,659 to 62,659. And that is the end of the game. If you add the amounts spent, which is around 11 million or so, to it, you will get your total cost of the asset. If you put all these costs together, whatever you get is the total amount spent plus the borrowing cost of 62,659. They will give you what? The entire cost of the asset. And that was the current amount they were looking for. Okay, just accept borrowing cost for calculation. So on that note, we are done for this. Unfortunately for us, this is how far the good Lord will bring us. I know that I will end here, but you are not done. You are continuing the question. Please make my questions ready for me. All the questions I'm giving you, please try them for me. And if subscribe to the channel, if you have not done that, to share the link with your friends and turn on the notification button to receive notification when new videos or lecture materials are uploaded. Okay, so that is fine. Please, question 5 and then the last question, kindly submit your answer. I'm begging you. This one I just got back questions 5 and then the last one, kindly submit your answer. Okay, so probably you end here. If you have any other questions, kindly let me have them. Kindly subscribe to the channel if you have not done that, and turn on the notification button to receive notification of new uploads. You can also request for the lecture material to be made available and join all our classes. We're inviting you to join our online classes and then free question solving. Join us and be part of the big team. We invite you to target professional consults. Okay. Have a nice day and stay safe with COVID and its related matters. Goodbye, everyone. See you in the next lecture.